And good afternoon. Welcome into a Friday, December 4th edition of Market Talk. I'm your host, Jesse Allen. Great to have you here. MarketTalkAg.com is our home on the web. You can find us there. Facebook, Twitter, Instagram. It is all at Market Talk Ag. You can find us on your favorite podcast sources, including Apple Podcasts, Spotify, iHeartRadio, Amazon Music, and now on Stitcher. You can find us there as well. Find us on our YouTube channel also and watch the video and audio podcast and see all of our archives as well. Big thanks to our radio affiliates on the web as well, including KMA in Shenandoah, Iowa, KASM in Albany, Minnesota, and the Alpha Media Farm Network joining us now. That includes stations like WIBW in Topeka, Kansas, as well as KWMT in Fort Dodge, Iowa, and KLGR, Redwood Falls, Minnesota, and so many more. Well, let's dive into this marketplace today. And as we wrap up the week, a down day in the grains after a nice rebound in corn and beans yesterday. Here to join us and talk about it, he is with CHS Hedging. Kent Beadle is our guest today here on Market Talk. Kent, how are you?
Great. I really appreciate you having me on today.
Hey, Kent, I appreciate you joining us here on a Friday afternoon. It's a dreary, gloomy day here in Nashville, Tennessee, and it's kind of a gloomy day on the markets, I would say. We saw a little bit of hope, I think, yesterday with a rebound in corn and beans, and then today we were down moderately once again, and we've seen kind of the bottom, so to speak, maybe fall out of this market a little bit with some end-of-the-month profit taking. A lot of producers scratching their heads at what's going on. Let's start just with corn first, Kent. And what are you seeing in this corn market? It's kind of just been holding range bound right now.
Yeah, well, I'll point out a couple of things. First of all, we have, in fact, had a fairly consistent sort of pattern going on as we approach first notice days. So that's where we were at the end of last week and into the first part of this week. There's a certain amount of hedge to arrive contracts out there that need to get priced. That ends up being hedge pressure in the marketplace. And then I think this year we're going to have a little bit different situation going into year end than what we've had in the past. And that is, it has not been a great year for ag finance, for producers' balance sheets. I mean, the marketing opportunities that we would expect to have in the course of the spring and summer were taken away by the COVID crisis. Mm-hmm. A lot of grain ended up getting sold prior to the rebound in mid-August because at that point in time, there were crops out there. Farmers needed to get their crop marketed. And as a result, incomes this year on the farm are down. And so from a tax planning standpoint, as well as worries about what the tax situation is going to look like next year, there's an awful lot more farmers that are looking for some additional income before year end. Mm-hmm. And so you take, you started a correction, and I think it was a technical correction earlier in the week that was probably driven by a little bit of, month-end producer selling, pricing of HTAs, what have you. And then it kind of blew up into some speculative liquidation. You have some long, a lot of long positions from the funds. Mm-hmm. And then when you get a rally like the one we had yesterday, well, growers thinking and knowing that they're going to have to make some sales before year end. Over the next few weeks, they may be a little bit more aggressive selling into these smaller rallies like we had yesterday. And I think that's what you saw today. And then going into the close, as the market kind of worked its way back over much of the session, then going into the close, I think you had another spate of liquidation from the hedge funds going into the weekend.
Lots of great insight there into what we've been seeing, Kent. And I look, at this market in general, and specifically, I guess, on the corn side, we kind of held this 420 range, and really, we've kind of yo-yoed back and forth a little bit. higher and lower, but still stayed kind of range bound here.
Yeah.
And for the most part, from what I've heard from producers, there's a lot more producers who still have corn in the bin versus soybeans right now. And so a lot of them are wondering what they should do with their corn market.
Yeah. Well, so to begin, I'd just tell you that, we have a longer term optimistic outlook.
Hmm.
It's an outlook that makes me a little nervous because it's not an unsimilar outlook as the one that we had a year ago. Okay. And that outlook a year ago got totally smashed by COVID, primarily, but also then by the fact that you had the USDA stick an additional 100 million bushels of corn into the balance sheet in January, things like that. And also, just a general disdain or disbelief, I guess, around the Chinese Phase 1 agreement, which is now being proven to be a little more substantial, and it looks as though they're actually making a good faith effort to get those dollars booked.
Hmm.
But all of these things that have happened over the last year have put the balance sheets in a position where we really believe, subject to either the Chinese disappearing or some other more extended concern around the pandemic, we think that next year is going to be a year where a really tight soybean balance sheet is going to impact a reasonably tight corn balance sheet, and it's going to result in some acreage battles this spring that are somehow going to have to be resolved. And as I look at the longer term view of corn, I actually have to sort of tack back to soybeans for a little bit. And the first thing I tell you is that you've got 190 million bushel soybean carryout. You've already shipped 87, or we've sold 87% of our current USDA sales estimates. So that number's not going to come down. It might go up. And we're at 4.2% of use, which is the second tightest in over 40 years.
Mm-hmm.
Okay. We're even at 1160. We're well below the kinds of price ranges that we've traded previously when we had this tight a balance sheet. More importantly, when you look at the following year's balance sheet for beans, 2021, if I keep crush steady and I raise exports 50 million bushels, which is reasonable considering the increase in the size of the Phase 1 commitment to the Chinese, combined with some of the drought concerns that we have in South America at this time, we need to plant 91 million acres of soybeans just to make the balance sheet work. Okay, to come up with I think 185 million bushel carryout. If we're going to plant 91 million acres of beans, tacking back to corn, that probably brings our corn acreage down from 91 last year to something closer to 89 this year, or maybe even a few less. And that takes next year's soybean or corn balance sheet down into the 1.4, 1.5 area. Mm-hmm. And that's just really, really tight for corn. So that's with large trend line yields of 180 bushels in corn and 50 and a half bushels in beans on those balance sheets. And we're going into next spring dry.
Yeah.
So the point is that you're going to have these corrections like we're going through right now. Makes sense. Market gets overbought. This is kind of a relief to the marketplace. You're gonna take some longs out of the market. Mm-hmm. These are things that are good technically, but fundamentally, we don't have a reason to try and go and buy more demand with cheaper prices. Quite frankly, we're on the cusp of needing to do something different. We may not be there yet. We don't know what the size of the South American crops ultimately are going to be, but we are on the cusp of having a situation where we may need to go to some prices where we actually shut down a little bit of demand. Mm-hmm. And if we end up with a disappointing crop year next year in North America, that becomes not just a small amount of rationing that would need to take place, but potentially a large amount. And we have to maintain some weather premium through the winter for the weather that we have next spring and summer. Mm-hmm. And that's why, we're going to be making recommendations to our growers for small scale in sales on rallies, but we're not going to get in a big hurry to put, to make a 60 or 70% sale at this price at this time. We've got an awful lot of weather and balance sheet resolution in front of us yet.
Very fascinating how you set all of that up. You covered a lot there in a short amount of time, Kent, but that all makes sense to me. And it's really is amazing when you boil it down like you just did, how many factors there are in this marketplace, especially right now in this environment that's all tied together. When you're talking corn, talking beans, I'm sure you factor wheat in there as well with challenges overseas. I mean, it's amazing how it's all factored in.
Yeah, and there's some offsets here too. I mean, you start with wheat, for example, and you're going to have a huge rebound in wheat production in Australia this year, for example. We're still competing against Ukraine and Russian bushels as well. And, the world wheat balance sheet, at least as it exists today, according to the USDA, still has a very large world wheat stocks to use ratio. Now, I have some concerns about that. Half of that world wheat supply, similar to corn, is in the hands of the Chinese. And quite frankly, I am not willing to believe anything the Chinese say about their stocks, because they actually don't say anything about their stocks. They talk about production, but they generally don't provide a stocks estimate, and the USDA essentially takes its best information and does what it can with it. But whether or not the Chinese has even half of the wheat that they say they have, I mean, who's to say? Mm-hmm. We're very confident that with the equivalent of $10 corn prices in China, that they don't have the corn that the USDA says they have. And but there is, at least appears to be, a fair amount of wheat, and at least the structure of the wheat market feels a little bit more like something that's in a surplus situation, like unlike corn and soybeans with $1.25 bean inverse that's sitting out there, and a flat, actually a July D's corn inverse of 20 or 15 cents right now as well. So, you have that kind of an offset, and then there's one other thing, and I talked about the selling from the grower that's probably going to happen here in the last month, and also I think there's just a whole lot of a concern. When you had a reasonably bullish setup last winter, and we made our highs in January, and memories are short, and people remember that the marketing situation in the last year is something that's likely to resonate. And I'm already kind of hearing it from the country. Well, gee, you were somewhat optimistic at this time last year, and look what happened. You're telling me to be optimistic sometime this year. Why isn't it going to happen again? Why aren't we going to break from this level and start going down and never come back? It's a concern, and it's one of those things that's going to make rallies generate some producer sales on a regular basis here, and especially this month as they're giving consideration to this year's income and their tax situation.
Very interesting. All of that. Great insight into this grain market right now, Kent. Let's switch gears. Let's talk livestock a little bit here on the program. Okay. This cattle market, we've kind of been stuck in this 110 range roughly on the live side. We were down a little bit on Friday. Feedlot country's been pretty quiet, last few weeks. Just haven't really seen the activity out there. But yet, I've talked to a few different people, talked to some producers, and they're still fairly optimistic with this cattle market right now. What are your thoughts on it?
Well, I think we're range bound, is what I believe, and I think that the market has some value to an end user down in that $104, $105 a hundredweight type area for live cattle. Okay. Given all of the challenges that we have with food service, restaurant demand, those sorts of things, I think that futures and and cash start to feel kind of expensive to me when you start talking about $114, $115, $116 on up to $120, and there are a lot of analysts that are optimistic that we could get up into those ranges. And typically this is a time of the year when seasonally you start, things start to kind of kick in and things, maybe get a little bit better. But I'm not surprised to see some of the weakness that we've had this week. I think that the progression of COVID and the actions of state and local governments to try to combat that is a negative that the cattle market just can't ignore at this point in time. Longer term, I think the setup is there, and honestly, we do have the vaccine coming. I think that coming vaccine not only helping things like the stock market, help the cattle market recover. To the extent that it did here as of, the last week or two when we made our highs. But I don't think that we can get away from the problems that we have right in front of us. Now, I think there's a lot of pent-up demand being built. I think there's going to be a lot of travel. I think there's going to be a resurgence in meetings and conventions. I do think people are going to go back to work. And I think after hanging around their house for a year, people are going to want to go. I think they're going to want to travel. I think they're going to want a vacation. I think that the things like conventions and the like, where an awful lot of steaks get served in hotels and at higher end restaurants. I think that's going to come back. I really do, because I think the American public really wants it to come back, and they're going to be the ones that drive this ultimately. But we're just not there yet. And so I'm not surprised that we see a little bit of setback here this week. Quite frankly, the cattle were quite a bit cheaper than where we settled. And I think that late break in the corn helped, put a little bit of a bid into the feeder cattle, and that helped drag the live cattle up into the close today.
Well, and you mentioned as well with all that demand, that pent up demand, and I wonder in the short term as well with the holiday season, and this could maybe spill over into the hog sector as well, into pork. How many people are going to be buying meat to grill at home, to cook at home for the holidays?
Yeah.
Will that retail demand help this market at all in the short term? But I think that's something that we obviously have to wait and see what happens.
Yeah, you're watching the cutout for that, and the entire marketplace here over the course of the summer has really shifted to try to meet that retail grocery demand, and to serve that consumer who is eating almost all of the meals now at home, as opposed to going out to the extent that we used to go out. And so I think we were already set up for it. I don't think it was too big of a lift to be able to provide enough product into that environment to satisfy that demand. But I mean, it's clear there's going to be a whole lot more smaller gatherings at home. I think back to my Thanksgiving experience here just a week and a half ago, and we had a much smaller gathering at our house, but we cooked exactly like we were going to have 20 people, right? So needless to say, I'm still eating turkey sandwiches and dressing.
Same here.
Right? So if you have a lot more households cooking a Christmas dinner and cooking it the way they normally cook it, yeah, there's going to be some sort of an uptick that we've probably already experienced. I think that the retail sector has probably got most of that beef booked and priced, and then we have to look on past that, to gauge that demand as we go forward from there.
Kent, Hog Market here, real quick. A little bit of a different story there. I've heard from folks. We were pretty quiet today on that market to round out the week, but we're just kind of seemed like we're a little range bound there as well. The 65, 70 range on the board. What are you seeing in hog?
Yeah, $65 has been just a magnet here to D's hogs. We've run up to 68. We probably traded down as low as 63.50 or thereabouts. But for a very long period now, we've been in this range. I mean, there's a couple ways to look at it, and I tend to look at it from the perspective that $65 December hogs, relative to where we've bottomed out the hog market in a number of previous years, is actually a pretty doggone good price. Okay, it's not a great profit builder for the hog industry, and with feed costs having rallied the way they are, it's definitely a loser. But we don't tend to make money in the hog business in the fall and into the early winter. The fact that we've held these kinds of levels this long, feels somewhat good to me. It tells me that our export demand into Mexico and into China remains very, very good. How long that lasts, I think the business into Mexico is going to last for a very long time. The question is, are we going to start to taper off exports into China? My gut is that next year the answer to that is going to be no. Yes, they are rebuilding their hog herd. It's coming back. Yes, they still have a lot of poultry online, so they're going to be they're going to be better supplied than they have been. But retail prices are still high, if not as high as they were, and we can still make you can still make hogs work into China, and I think you're going to see that meat continue to move in that direction here for a good while. Keep in mind, that's another big component into that phase one agreement and the $43.5 billion they need to purchase next year.
Kent, all great insight here today. Really, really enjoyed our conversation. Any final thoughts you have before we wrap up the program?
Yeah, just I would just say that it's going to be a choppier, more volatile year. But I would caution against coming to the conclusion that this year is going to be like last year. I think that next year has a much better chance of having good marketing opportunities and potentially opportunities at levels quite a bit higher than where we're at right now.
Well, Kent, if folks want to reach out to you and the team at CHS Hedging to get a little help with their operation, what's the easiest way to do that?
So all our contact information is at www.chshedging.com. I can also be reached directly at 800-851-0892. We'd be more than happy to, take calls from you viewers about their situation and see if there's something that we can do to help them out with their marketing.
Well, Kent, I appreciate the time. Thank you for being a guest on Market Talk and look forward to having you back on in the future.
Yeah, we'd love to do it. Thank you so much, Jesse.
Kent Beadle with CHS Hedging, our guest today here on Market Talk. Find us online, markettalkag.com, and all your favorite podcast sources, including Apple Podcasts, Spotify, and so many more. This has been the Friday, December 4th edition of Market Talk. I'm your host, Jesse Allen. Have a great afternoon.